Today is Wednesday, February 24th, and this is a post-market review for the stock market activities today. Welcome back to Bizarro Land. The video game market is back. The circus from the testimony of the Federal Reserve Chairman, Jerome Powell, goes on. And today we heard more bullshit and deception from the chairman as expected. Federal Reserve Chairman Jerome Powell repeated Wednesday the central bank's intention to maintain ultra-low interest rates and continue hefty asset purchases until the economy recovers further in a second consecutive day of testimony on Capitol Hill. So, as expected, the lies and deceptions from Jerome Powell goes on. His main purpose from this testimony is to assure the market not to worry about inflation, because inflation or not, he's just gonna play blind and continues to print with no end on sight. Mission accomplished, at least for 2 days now. The dip has been bought by retail traders, being assured by Papa Jerome to step back in the casino. The water is warm, place your bets, and don't forget to double down. But before you do that, make sure you have your blindfold on. Powell, no one can really identify an asset bubble. And perhaps Mr. Powell cannot really identify an asset bubble either because he's blind, forgot to put his glasses on, or that he has never seen an asset bubble before. So let's find one for him. Ta-da! GameStop shares soar more than 90% in late afternoon trading, and make that 200% when you add the gains from the after-hours session. We're back, baby. Here comes the short squeeze once again, and the maniacs live for a second season. The rumor has it will end up the same way the previous season ended. And spoiler alert, the first season ended with all of these donkeys getting slaughtered. And here are the activities from the after-hours session. It is not just GameStop. It is AMC, COS, BlackBerry, Nokia. The Wall Street bets names are back. And if you thought that this is over, you have not seen anything yet. So I don't know, Mr. Powell, do you see an asset bubble here? Of course not. Continue to deny, and then deceive. Oh, and we heard from legendary investor Charlie Munger, and he had a lot to say about the current market mania, from GameStop to Robinhood to SPACs. We will cover all of that during the headlines of the day segment, but let me give you a sample of Charlie Munger's warning.
Frenzy is fed by people who are getting commissions and other revenues out of this new bunch of gamblers. And of course, when things get extreme, you have things like that short squeeze. It's not generally noticed by the public, but clearinghouses clear all these trades. And when things get as crazy as they were in the event you're talking about, there are threats of clearinghouse failure. So it gets very dangerous. And it's really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors. And of course it's going to create trouble, as it did. And I have a very simple idea on this subject. I think you should try and make your money in this world by selling other people things that are good for them. And if you're selling them gambling services where you rake profits off the top, like many of these new brokers who specialize in luring the gamblers in, I think it's a dirty way to make money, and I think that we're crazy to allow it.
And here is a tweet I released today. Remember that the rise of GameStop was the accident scenario that was so close to blowing up the stock market bubble. Remember that the Nasdaq was sold off severely during the GameStop Mania Season 1, and the entire market was about to blow up. Now it is back along with inflation fears, meaning that the accident that almost KO'd the market a few weeks ago is back on the table in addition to the inflationary fears This market is about to blow up because you have the inflation fears, you have the GameStop stock mania, and you have another round of stimulus that will add more and more to the pressure, and this market is going to blow the hell up. And this is, of course, a sight to see for bears who've been waiting and anticipating this event. The donkeys who are chasing the mania with their zombie mentality of just chasing the hot names from TikTok, Reddit, and they brag to you about their quote-unquote gains. And we know that all of that is just paper gains. And these morons will spend 12, 13, 14 months creating a massive asset bubble, bragging about quote-unquote gains, and not caring about any fundamentals whatsoever. And what happens is, the bears stalk, and the bears wait. And they wait for that one strike to slaughter all of these donkeys and take all of the gains that took them 14 months to make in just 14 days. A massive transfer of wealth is about to happen. We'll talk about that and a lot more. But for now, we do have a market to cover, and here we go. The Dow Industrial Average closing in the green by 424.51 points, or a gain of 1.35%. The Nasdaq closing in the green by 132.77 points, or a gain of almost 1 percentage point. The S&P 500 also in the green by 44.06 points, or a gain of 1.4%. The indices opened lower, specifically for the Nasdaq, but we saw the dip buying happening right the moment where Jerome Powell started speaking. It's the same deja vu action from yesterday. And of course, we see outperformance from the Dow and the S&P 500 versus the Nasdaq, because the inflationary names happen to reside in the Dow and the S&P 500. Financial names, industrial names, material names, energy names, and therefore you see the Dow outperforming the Nasdaq, where all of the de-inflationary trade names reside. What about the sector's performance for the day? Leading the pack, per usual, energy and capturing the gold medal. At number 2 for the silver, financials. And at number 3 for the bronze, industrials. Number 4, materials. So as you can see, the inflationary trade is outperforming, not just today, but for a while now. However, we saw a comeback from the technology sector, and the question is, how sticky is Jerome Powell's assurance that we don't have to worry about inflation right now, and that he's going to continue to print, which market participants took as a green light to buy the dip, and they bought it in technology. So if they're going to continue in this path, they will start to dump the inflationary trade, moving some of that cash back to the technology and momentum names. That remains to be seen, because these sheep who bought the dip today have no strategy whatsoever. They're just crossing their fingers that yields are not going to continue to rise higher. Moving on to the futures market performance, and what do we see here for today's session? Massive gains once again for crude oil. The WTI closing at $63.41 a barrel. Meanwhile, Brent closing at $67.20 a barrel. Massive gains for crude, and of course they're telling us that we will reach 75 by the end of the year. I think we could reach 75 in a couple of weeks, given this rate. Inflation continues to rise hotter and hotter by the day. What about softs? We saw declines for coffee after a massive run the last few days, but other than that, softs futures scored major gains for today's session. Lumber, sugar, OJ, cotton, coca, all closing in the green with massive gains. What about metals? Gold remains muted. Gold is a mature guy in the room. Gold likes to wait for confirmation before rallying any further. What is that confirmation? A decline in the US dollar once we get a confirmation of the new stimulus bill. But the rest of the party in metals, they don't like to wait, and they like to party on. Silver, platinum, copper, palladium, all closing in the green. Massive gains, specifically for platinum, copper, and palladium. What about meats? Massive gains for lean hog, feeder cattle, and live cattle. Grains, similar story. Massive gains for soybeans, soybean oil, wheat, you name it. While the market is taking Jerome Powell's assurances with certainty and they are buying the dip, the futures market is telling a different story. The futures market is saying we could care less about whatever puke comes out of Jerome Powell's mouth. The market is aware with the facts and sees inflation everywhere. And therefore, you see futures gaining significantly today. What about the big casino, the options market? What's going on here? The action in the casino is heating up once again. It's loud, it's packed, it's full of life. It's going to get hotter and hotter in the days to come. Apple at number 1 with around 1.25 million contracts traded today. About 74% of those are calls. AMC at number 2 with 1.2 million contracts exchanging hands today. About 85% of those were calls. Tesla at number 3 with around 700,000 contracts, but 64% of those were calls. We saw significant call options buying activities across the board, whether you're talking about the Wall Street bets names or even classic names such as Ford, Boeing, reopening names, American Airlines, Carnival Cruises, donkey names such as Palantir, Churchill Capital. It doesn't matter. Even though they know that Churchill Capital is going back to 15, they continue to buy call options on the name. Massive mania in the casino today. Now, what about the interesting trades that took place in the options market today, starting with the XLF, the financial ETF. We know that financials are entering, or already entered for that matter, a super cycle due to the rise of treasury yields. And here we have somebody betting on more gains for the financial ETF by buying the 37 calls, expiration date May 21st. And they paid about $45 a piece to enter this trade, which brought the total all the way to about $3.5 million. Here's another interesting one for the Qs, the Nasdaq. Somebody's buying the 292 puts, expiration date March 12, and they're expecting the Qs to decline over 10% by then. So they are betting that the action we saw in the Qs today and yesterday is a dead cat bounce. And they paid about 85 cents a piece to enter this trade, bringing the total to about $1 million. Here's another interesting one for the ticker FSR, Fisker Motors. The name is rallying significantly today, over 38%. And perhaps we will see the gamma squeeze continue for a few days in Fisker. At least this is the bet this particular trade is making. By buying the 25 calls, expiration date March 5th, with expectation that Fisker will climb over 11% by then, and they paid about $1.90 a piece to enter this trade, and that will bring the total to about $2 million. What about this trade for the ticker GPN? This is for global payments, and somebody's buying the 220 calls, expiration date March 19, with expectation that the name is going to rally over 7% by then, and they paid about $1.50 to enter the trade, and that brings the total all the way to about $1.5 million. Here's another big one for Square. Somebody's making a bearish bet here, betting on a continuation of the downward move we saw today in Square after reporting their earnings yesterday. Of course, that is due to their involvement in Bitcoin. They're buying more Bitcoin, and if Bitcoin goes down, so will Square. This trade, buying the 220 puts, expiration date March 12, with expectation that the name is going to decline by over 7% by then, and they paid about $5 a piece to enter this trade, bringing the total to about $4 million. Here's another interesting one at the bottom of the table for the RKKK, Tesla witch Cathie Woods. Of course, it becomes a delicious target for bears due to the flaws in the structure and the mania behavior Cathie Wood is engaging in right now. We saw massive declines for this ETF, but there are bets that the pain will continue and that the ride with Tesla witch Cathie Woods will perhaps not end up in a safe destination. And in this case, they're buying the 115 puts, expiration date April 16th, with expectation that the RKK will decline over 17% by then, and they paid about $4.20 a piece to enter this trade, bringing the total to about $3 million. Continuing with interesting trades. Here was one for TSM Taiwan. We saw those names taking a break just for a little while, and of course, right away we saw the resumption of the bullish bets for the semiconductor names in anticipation of a plan the Biden administration has to revamp chips production here in the US. In this case, they're buying TSM calls, specifically the 144 expiring March 19th, with expectation that the name is going to decline over 9% by then, and they paid about $1.80 to enter this trade, which brought the total all the way to about $1 million. Here's a big one for Tesla. Somebody's buying the 695 puts expiring March 19th, with expectations that Tesla will decline over 6% by then, and they paid big bucks for this one, about $28.50 a piece, bringing the total to about $17 million. Massive trade against Tesla, or shall we say, the souffle. At least this trader thinks so. Here's another massive bet for Nvidia. Somebody bought the 700 calls, expiration date May 21st, with expectations that Nvidia will rise over 21% by then, and they paid about $17.30 a piece to enter this trade, bringing the total to about $10 million. Moving on to the headlines that shaped the day, starting with macro, inflation, and Fed news. Can you see inflation? Because the Federal Reserve cannot see any inflation going on in the economy. So perhaps we can help them out here by showing them some facts and data. Starting with housing prices. Housing prices continuing to spike. The S&P CoreLogic Case-Shiller Index of property values rose 10.1% year over year in December, the largest since 2014, following 9.2% gain in November. Phoenix, San Diego, and Seattle posted the largest gains. But perhaps you're not convinced yet that inflation is rising everywhere. May I present you with some more evidence? The latest commodity price gains are being driven by money inflows and inflationary expectations rather than actual physical buyers. This is what happens when you print money out of thin air and you usher the tsunami of liquidity all over the place. Everything becomes a casino, and the casino behavior could lead to an inflationary disaster. Commodities adjusted for inflation, and they're calling it the beginning of the super cycle in commodities, meaning that whatever tools Jerome Powell thinks he has against inflation, he better rethink, because he is the tool, and inflation this time around will be driven by commodities prices. Unless you can print 3D corn, I don't want to hear about, oh, but what about the de-inflationary pressures, bro? Here are some de-inflationary pressures for you. U.S. manufacturers grapple with steel shortages, soaring prices. Steel prices are also in a bubble and rising and skyrocketing higher and higher and higher. And that will add to more and more and more inflation. Soaring prices are driving up costs and squeezing profits at steel-consuming manufacturers, provoking a round of calls to end former President Donald Trump's steel tariffs. Domestic steel mills that idled furnaces last year amid fears of prolonged pandemic-induced economic downturn have been slow in ramping up production despite a recovery in demand for cars, trucks, appliances, and other steel. Capacity utilization rates at steel mills, a measure of how fully production capacity is being used, has moved up to 75 after falling to 56% in the second quarter of 2020, but is still way below the 82% reading in last February. The demand is hot and the supply cannot keep up. The supply is playing catch up from behind. Lucky to break even Domestic steel prices have risen more than 160% since last July, leaving steel consumers in a quandary whether to absorb or pass along the increased cost. "We'll be lucky if we break even at this price," said Stuart Speyer, president at Tennessee-based Tensico. Steel costs for the manufacture of lockers, bookcases, and cabinets are up 98% in the past 6 months. Whirlpool last month said increased steel costs would shave 150 basis points from its profit this year. Farm equipment maker AGCO and crane maker T-Rex have announced price increases to offset material costs. In its flash purchasing manager survey for February, the IHS Markit's prices paid index for factories was the highest since 2011, and its gauge of prices received for finished products was the highest since 2008. Hello inflation, but here's more. Credit card companies are taking another swipe at merchants with higher fees, taking advantage of every aspect of inflation. And I know what you're going to say here. Oh, but higher rates will discourage consumer spending, and therefore you will see a drop in inflation. And you might be right in the short term and in the very narrow scope of credit card fees, because here is the chart from Chase Consumer Card Spending, and this is their tracker chart. And you saw a massive drop in February, and we are already curling downward. So perhaps the consumer is being cautious and they are not using their credit cards as often as they can. However, if inflation persists, you will see that inflation expectations will continue to rise higher, and that will create a FOMO phenomenon, where everybody will rush to use their credit cards to buy things they expect prices for to rise higher in the next few months due to inflation. Buy now before prices continue to go higher. That in itself creates the spark that ignites consumer spending and usage of credit cards. So the moral of the story here is that this environment will be very good for credit card stocks. Visa, MasterCard, American Express, Capital One, all of these names will outperform because they're capturing more fees, and they will see a recovery in volume very soon, and rates will continue to go higher and higher due to inflation, which means that they will be able to charge even more and more interest rates. And the inflation is starting to become a global phenomenon. Not just a case limited to the United States. Eurozone manufacturing input prices soared in January. Purchasing managers' input price sub-index below 50 equals a majority of business reporting a contraction. Well, we are reading 65 and above, signaling the opposite of contraction. What they are seeing instead is inflationary prices. Increasing input prices will lead to passing all of that cost back to the end customer, leading to more and more inflation. And now that you are aware, with the many facts that I just presented to you, that inflation is getting out of control, well, rest assured, the Federal Reserve is blind. Here's an example. Fed's Vice Chairman Clarida do not expect sustained upward inflation pressures. Here is more from these clowns. Fed Chair Powell says he is confident that the Federal Reserve can reach 2% inflation and moderately exceed it. Is that what you tell your wife, Jerome Powell? I'm just going to reach my drinking limit and exceeded that just moderately by drinking an additional 20 shots or so of rum. And we all know how that movie ends, Mr. Jerome Powell, are we not? More from Jerome. We believe we can do it. We'll do it. May take more than 3 years, or 2, or 1, or maybe half a year. We have no clue. But rest assured, if inflation gets out of hand earlier than expected, the Federal Reserve has the tools to deal with that. Powell on inflation. We don't have a formula, and we wouldn't have a formula. So what is the tool here, Mr. Jerome Powell, without a formula? And perhaps this is the tool. Here's Jim Bianco. Powell, we have tools to deal with unwanted higher inflation. Yes, and I have a bonzo to deal with a gangrene leg. The idea is to not to get to this point. But of course, if inflation gets out of hand, Jerome Powell will have to grab his chainsaw and chop up the leg, and that leg will be from the retail traders and investors' side. The Wall Streeters will get the memo ahead of time. And how could we trust the Fed when their entire system almost went down today? Here it is. The Fed's system that allows banks to send money back and forth is down. The Federal Reserve's system that allows financial institutions to send money back and forth electronically went down for several hours Wednesday, but appeared to be coming back online later in the afternoon. Well, how reliable of them. The quote-unquote operational error, as the Fed described it, impacted multiple services, including its pivotal automated clearinghouse system, which connects the depository and related institutions sending electronic credit and debt transfers. And I have a theory on what caused that quote-unquote operational error. Moving on, President Biden will sign an executive order directing a broad view of supply chains for critical materials, from semiconductors to pharmaceuticals and rare earth minerals, aiming to spur domestic production while strengthening ties with allies. So here comes the state planning, right? This is Marxist capitalism, which says that it's okay to conduct Marxism so long as the Marxism is limited between the government and corporations and people are excluded. These are private companies. Let them figure it out. We don't have to subsidize their projects. That should come out of the revenues. More in macro news regarding the Biden administration. We are waiting and anticipating the new round of stimulus. And of course, the corporations and the Wall Streeters are licking their chops, waiting and waiting for the poor and the middle class and dumb money to grab that stimulus and hand it away to corporate America. Congress should act swiftly and on a bipartisan basis to authorize a stimulus and relief package along the lines of the Biden-Harris administration proposed American Rescue Plan. And this is a vote of support from Goldman Sachs CEO, because perhaps the CEO of Goldman realizes that once the government throw the helicopter money all over the place, that some of that money will land into Robinhood accounts, into the options gambling mania, and the majority of the donkeys are going to lose their money, and when they lose the money, that money gets transferred to the pockets of Goldman Sachs. And of course, what's going on in Treasury land, in the bond market, because we're talking about inflation here, and the Fed is continuing to deny, and then try to manipulate. Here is an illustration. The Treasury sold 60 billion of 2-year notes today at a premium, above 100 cents on the dollar, something that has never happened before. Of course, they're doing so, the Treasury Department in this case, to push the yields lower and lower. More deception, but it's not working. And perhaps they should give up here, trying to manipulate the market and allow a free market to take place, because here is from the Financial Times. Fed needs to ignore taper tantrums and let longer rates rise. Central bank should take its cue from a baby sleep training technique. A steeper curve, therefore, is a simple measure of better bank profit margins and has in past cycles spurred greater willingness to lend. Historically, the Fed's survey of senior bank lending officers shows banks have been more willing to make loans to the real economy when the yield curve has been steeper. In essence, the Fed could unleash the lending capacity of traditional banking system by letting the yield curve steepen further. So if Jerome Powell really interested in recovering the economy, he should allow yields to rise higher to encourage banks to issue loans to small businesses and the likes to reopen and expand. More lending equals more expansion. But of course, the Federal Reserve is not here to really save the economy. The Federal Reserve has a main mandate, and that mandate is to protect, preserve, prop up, and inflate the assets of the wealthy, stocks and real estate. So they will continue to deny, brushing away inflation fears and only attempting to address the matter via manipulation. And you know who needs loans? Our farmers. We need banks to be incentivized to issue more loans for the farmers. Because under the Trump administration, we have become a socialist state for farmers. Instead of helping them by opening a free market where they can sell their products and make their own money, we decided to start a trade war and give farmers checks instead. And now the grain prices are exploding higher, farmers need to catch up from behind and resume their farming activities. They need equipment, and we need banks to be incentivized to lend them that money to restore their businesses. Because here is what happened under the socialist system for farmers under the Trump administration. In Trump farm bailout, top 1% reaped nearly 1/4 of aid. The Trump administration's farm bailouts steered an expanding share of subsidy payments to the nation's biggest farms, according to an analysis by an environmental advocacy group that highlights issues of equity as the Biden administration designs potential new climate-related financial incentives for farmers. Just 1% of farm aid recipients collected 23% of subsidy payments in 2019, up from 17% in 2016, as former President Donald Trump's trade bailout swelled payments to farmers. And just like any system coming out of the government, it is a corrupt system that benefits the 1%, whether it is farmers' bailouts or PPP loans. Their portion crept up to 24% in the first half of 2020, the most recent period covered in the data, as farm aid hit a record level with coronavirus relief payments, according to the Environmental Working Group analysis. The swamp illustrated for you. And now, moving on to sentiment news. Let's see what's going on in the video game market. What's going on with the maniacs, the zombies, the Robin Hoodiots, once they realize that they just bought lottery tickets and the drawing date is about to happen, and chances are they're not going to win. Here's a sample from the donkeys.
I lost over $11,000 in the market today. Today was absolutely brutal, absolutely crushing. Tesla couldn't hold on to any resistance, couldn't find the floor. Apple couldn't find the floor. What is going on?
This is, of course, happening because you guys are zombies high on meth and you have no clue what you're doing. You're just chasing tickers that you hear from other TikTokers and Reddit users. And then you are surprised when things don't work your way. You're chasing a lottery ticket. Speaking of lottery tickets, we know what happened to SPAC Churchill Capital, declining over 50% now from the highs. But of course, the donkeys did not get the memo that you are not supposed to push the valuation of the SPAC to become higher than the underlying company it intends to merge with, in this case, Lucid Motor.
Tell me you're broke without actually telling me you're broke.
So Friday I was day trading CCIV calls. The stock ended up closing negative 7%. My account did minus 30%. I ended the day buying all March calls. Entire account in March calls for CCIV. Knowing damn well they were announcing the merger this week, and it's been running up in the anticipation for the merger. And well, they announced the merger all right. And the stock dipped 18% after. So now my calls are probably going to open up at like minus 50, minus 70%. It's going to be morbid tomorrow. Talking, taking the car, scuba diving, kind of morbid. I mean,
Oh gee, we did not know that. More losses, more risk-taking, more stupidity, and this movie is going to end with a massacre because they're not going to stop until they lose every single penny. That is the journey of the gambler. Now they will see the revival of the Wall Street bets short squeeze. They're going to continue to take more risk and more risk and more risk until they lose it all. What about the ARK Mania? What's going on in Cathie Wood land? ARK funds bought more than 240,000 shares of Tesla on Tuesday. This is the so-called dip for Cathie Wood. Tesla climbs 4% as Cathie Wood and others buy the dip after a multi-day skin. Of course, Cathie Wood buys first, and then she lets you know with a spreadsheet, and the zombies follow her to the slaughter at higher prices. More from Kathy Wood. Kathy Wood sees Bitcoin as insurance against wealth seizure. Okay. ARK stamp for 2025 for all of their disruptive technologies is 3.2 trillion. For 2030, 6.6 trillion. The total 2020 revenue of the 18 largest tech companies, Apple, Samsung, Foxconn, Alphabet, Microsoft, Huawei, Dell, Intel, Facebook, Tencent, was only 1.8 trillion. But this is the fantasy land that the ARK maniacs live in. Related, her flagship ARK ETF saw a record outflow amid a 2-day rout. And a lot of Tesla Witch Kathy Wood's investors are starting to sense that this person doesn't know what she's doing whatsoever. She's only relying on the Holy Spirit to visit her in her dreams and feed her tickers. It is faith-based investing with Kathy Wood. And here is what happens when faith is misguided. Commercial electric vehicle maker Workhorse saw shares prices cut in half Tuesday after the USPS decided to go with a bid from Oshkosh for delivery vans. They lost the contract. And here it is. Fun fact, the ARKQ, this is one of Tesla Witch Kathy Wood's ETFs, owns 2.6 million shares of Workhorse. And guess who called the whole thing? Last year, Hindenburg Research. Short sellers are trying to warn you and protect you from fraud in the markets. This is from Hindenburg Research. We are short WKHS because we think there is immediate 50% downside. The company has an astronomical valuation of 1.5 billion despite less than 100K in revenue last quarter. We see the chance of winning a material USPS contract as virtually zero. A reality check is on its way. It took a while, but Hindenburg turns out to be correct. And Tesla Witch Kathy Woods, of course, investing based on hopes and dreams, and sometimes, or most times rather, hopes and dreams don't come to fruition. Once again, faith-based investing. And here is what I said about the ARK Mania. If you are investing with ARK, you are pretty much handing your cash to Kathy Wood, who'll blow it in the casino. History will repeat itself. Google what happened to the hottest .com funds in the aftermath of 2000. Names like Putnam, Emerging Growth Fund, and Munger Net Fund. History will repeat itself. Moving on to the tulip mania of the 21st century, Bitcoin. Square said it bought 170 million in Bitcoin, raising its holdings to about 5% of the company's cash and equivalents. Massive risk-taking from Square. And you saw the shares trading down significantly today. Square CFO explains its 170 million Bitcoin buy. I'll save you the time. Because delusional CEO Jack Dorsey wants us to. Meanwhile, Mr. Dorsey himself has been dumping Square shares like there is no tomorrow. Here is more for the 21st century's tulip mania. MicroStrategy buys additional 19.5 thousand bitcoins for the price of 1.3 billion. Absolute insanity. And here is more in the insanity from JP Morgan. JP Morgan's Kolanovic says it's hard to find any bubbles in the stock market. Enough with the mania, and let's visit Sanity Land with legendary investor Charlie Munger, because he had an interview today and he talked about a lot of things going on in the market today, from Robinhood to GameStop to Bitcoin to Tesla and other subjects. So let's hear what Charlie Munger had to say. A lot of investors crowd into buying stocks on frenzy, frequently on credit because they see them going up. And of course, that is a very dangerous way to invest. Shareholders should be more sensible and not crowd into stocks and just buy them just because they're going up and they like to gamble. I think it must end badly, but I don't know when. And here's what Charlie had to say regarding GameStop. That is the kind of thing that can happen when you get a whole lot of people who are using liquid stock markets to gamble the way they would in betting on race horses. It is very dangerous And it is really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors. Of course, that is going to cause trouble as it did. And here is what Charlie had to say regarding Robinhood and commission-free investing. If you are selling people gambling services where you make profits off the top, like many of these new brokers who specialize in luring gamblers in, it is a dirty way to make money, and I think we are crazy to allow it. Human greed and the aggression of the brokerage community creates these bubbles from time to time. Wise people just stay out of them. I'll read this again. Wise people just stay out of them. When you pay for order flow, you're probably charging your customers more in pretending to be free. It is a very dishonorable, low-grade way to talk. Nobody should believe that Robinhood's trades are free. And here is what Charlie had to say regarding SPACs. The world would be better off without them. This kind of crazy speculation, an enterprise is not even found or picked out yet, is a sign of an irritating bubble. The investment banking profession will sell shit as long as shit can be sold. When asked about Tesla or Bitcoin and which mania would he choose to invest in, he quoted author Samuel Johnson, who when presented with two choices said, "I can't decide the order of presidency between a flea and a louse." Charlie also talked about value investing. Value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy the stock. That approach will never go out of style. Not for the Robinhoodians. The Robinhoodians, their value investing is to buy a stock high with no regards to the fundamentals, financials, or any analysis. Just put your blindfold on and buy, and never sell diamond hands, bro, until you lose everything. Continuing with Charlie regarding value investing. All good investing is value investing. It is just that some people look for value in strong companies and some people look for value in weak companies. He also commented on psychology. It is one of the most ignorant professions in the world, Munger said, highlighting that many psychologists cannot connect what they know with other types of knowledge. He also talked about physics and investing. I don't use much physics in investing. Occasionally, some damn fool would suggest something that violates the rules of physics. I will always turn off my mind when I realize the poor bastard doesn't know anything about physics. He also talked about the secret to long, happy, and healthy life, considering that Charlie Munger is 97 years old. I don't have any secrets. I'm alive because of a lucky genetic accident. I think I would have lived a long time if I'd lived a different life. And of course, the Robinhoodians would say that Charlie Munger is a dinosaur and he doesn't know anything about investing. We know the future, bro. We buy SPACs, you know, the SPAC generation. We buy Reddit stocks, TikTok stocks. This is our investment philosophy. Put your blindfold on and buy. Ask questions later. Matter of fact, don't ask questions at all until you lose everything. And here is what Dinosaur Charlie says about the moronic Robinhoodians who call themselves we are the new Charlie Munger. Moving on to corporate-specific news, starting with Apple. The search for the iCar goes on. Apple supplier Foxconn reaches tentative agreement to build Fisker's next electric car. We saw the shares of FSR surging significantly higher based on this news. What about Hyundai? Hyundai recalls Kona EVs over battery fire risk. I thought they just released this model and they're recalling it already. What about Boeing? Pratt & Whitney engines on Boeing 777 jets will need to be inspected before those planes can fly again, according to an emergency order from the FAA. And of course, shares of Boeing rallied higher in celebration with the engine fire's optimism. What about Taiwan? Arizona emerges as manufacturing hotspot in the US, a push to insulate semiconductor supply from China. We know that Taiwan is building a massive factory in Arizona. And the question is, if the Biden administration conducts their socialist program to build factories for other semiconductor makers, where would that be? The answer is Arizona. What about McAfee? Deutsche Bank analyst Patrick Colville raised his rating on McAfee stock to buy from hold. He and other analysts raised their targets for the price, including the Maverick of Wall Street. I tweeted positively about this name that I am thinking of adding McAfee to my portfolio. They're delivering significant growth, and the valuation is not that ridiculous when you pin it to the mania going on in the market right now. And lastly, in corporate specific news, what about Fry's Electronics? Remember that? Well, they're shutting its doors for good. Goodbye, Fry's Electronics. Of course, had I been the CEO of this company, I would have never shut down. I would have merged via SPAC. I went to the open market, and the Robin Hoodiots and the zombie traders would pile into the stock. It becomes a Reddit meme stock, and to the moon, bro. Then we raise money, we dump a bunch of shares on the little heads, and we'll be financially sound once again. Moving on to the heat map analysis, let's see what's going on. The inflationary trade remains on top. We're talking about energy, industrials, materials, and financials. But we also saw some of the mania names joining the rally, such as Tesla, Neo, Airbnb, Snowflake, etc. In addition to a rebound in some of the software names and semiconductor names due to the news from the Biden administration. The bulk of the losses was concentrated in big technology names such as Apple, Amazon, Facebook, all lagging the activities in the stock market. We also saw significant losses here for Home Depot and Lowe's due to their earnings. And the question here is this the beginning of taking profits from the inflationary trade and buying the dip in the technology and the momentum side of the roulette table? Moving on to the charts analysis, starting with the SPY 15 minutes chart. Taking a look at the activities since last week all the way to where we traded today, gapping lower, but once again the dip buyers stampeding to push the market higher. We saw the wedge, the break higher, and then the series of bear flags, followed by a head and shoulder formation which took us lower to create another bear flag from which we gapped significantly lower, and we saw a bottoming process of the ABC pattern that took place yesterday. Today we gapped lower, but once again the dip buyers pushed us all the way where? To the resistance of the wedge limit. You see the trend line holding steady, and of course we knocked once, we didn't get it, we knocked again, and we will see if the SPY is going to be able to break higher. The assumption is that there is no reason for a massive sell-off in financials, energy, materials, industrials. Matter of fact, these are the names that will benefit the most from higher inflation. So the blow to the SPY, even in the event of a massive sell-off, would be a lot softer than public enemy number one, the Nasdaq, under high inflation. So the look for now is, from a 15 minutes perspective, is that the SPY is going to try to crack above the trend line by tomorrow. Zooming out to the big picture, the daily chart of the continuous contract of the SPY. We talked about the bull flag formation being intact so long as we don't close below 3,862. And you saw a massive reversal higher for the SPY today, still trading in the range of all-time highs. Once again, the SPY is not the index under threat here. And the bearish picture starts and stops with a level of 3,862. Breaking below, the bullish scenario back on the table. Trading away from that number, the bull flag scenario plays out. What about the Qs? 15 minutes chart. Once again, a series of bear flags, and then we caught support from the support level of 313, and we've been trading away from that number since then, even though gapping lower earlier in the day, but dip buyers showed up. But let's zoom out just a little bit here to the 30 minutes chart. We broke the trend, bear flag formation, followed by a series of bear flags, but when we look at the big picture here, the whole formation is just a giant bear flag in the making that is supposed to take us lower to retest the level of 313 at least. The Qs are looking much worse than the SPY. Zooming out, the continuous contract of the Nasdaq from a daily perspective. What do we see here? We had the massive correction of about 8 percentage points or so, not just piercing below the purple line, but also reaching the support line of 12,766 before bouncing higher. And for now, all in all, we see a bear flag formation, and we are supposed to go lower until and unless we recapture the level of 13,599 and tested for support. Negative divergence on the RSI, signaling that the weakness in momentum is still here. And what about the inverse index of the Qs? I predicted a breakout higher a few days ago before the week started. For the SQQs out of the wedge, we saw the bull flag formation, and I expected the name to rise higher. And I did buy call options, and we went all the way 19% to the upside, all the way to the top before retreating lower. What do we see in the big picture? The formation is just another massive bull flag waiting to play higher. So if the Nasdaq is going down, SQQ will go higher. And I added to my position here for the call options for the SQQs. The bull flag dies if we trade below the level of 13,1280. That would be pretty much a solid signal that we will trade lower. What about the IWM 15 minutes chart for the small caps? Riding higher, outperforming every other index. When we see the nostalgia names, the reopening names catching a bid, the IWM is their representative. It catches a bid right away. We're back at trading within the channel's limits. Let's zoom out and see what's going on here. We are still seeing a series of higher highs and higher lows. Until that is negated, the next leg should be higher. Even though, and I keep repeating this every single video, we are running out of momentum. You can stretch it however you want, but you are running out of fuel. Moving on to the Dixie. Nothing changed today, pretty much a flat day for the Dixie. We're still waiting whether the head and shoulder formation is going to play out or not. It is likely to happen because we went all the way once again to the resistance level of 90.5 and the Dixie reversed lower, signaling that we will see down prices for the US dollar. What does that mean for gold? I'm still bullish on gold right here. I bought at the level of 1765, anticipating the double bottom formation, and now we are struggling around the former resistance level, now support of 1800. I think we're consolidating in a bull flag formation, and there are higher prices for gold to come, specifically all the way to the level of 1870. What about copper? We're talking about Freeport McMoran. A lot of you ask me, should you buy, should you wait? Well, the last few days, you get a nice dip to buy. For now, Freeport is consolidating in a bull flag formation, readying to blast higher, because the 40 level becomes a psychological goal and acts as a magnet for the chart to lift higher. 40 will likely be a very strong resistance, and we are likely to trade lower if we reach 40 in a rapid manner. What about the TNX, the 10-year Treasury yield? 2 days of bullshit from Jerome Powell, and yields are still trading higher, as if he said absolutely nothing. The market is calling Jerome Powell's bullshit. Yields still going higher. We are nearing a point, however, of a turnaround in yields and trading lower at least for a little while. That could be the 1.5%, which everybody's touting as the level that will crash the rally. And then we will see yields retreating lower as we see the market entering another massive correction. I'm reading the tea leaves for you. And for that, let's visit the TLT. The TLT been whacked significantly, breaking the channel all the way down as expected to the support level of 139.20. This is going to be a strong support, and we are seeing oversold conditions in the TLT. We saw a massive sell-off in bonds since the beginning of the month, and we are seeing a massive short positioning being taken for the TLT. So I do expect a short squeeze to happen in the short term, where yields are going to go lower and the TLT will start to recover for the short term before reversing to yields going higher. What's going on with the VIX? The VIX had a massive down day, failing to crack above the level of 25. The crossing in the MACD is still on the table. If it happens, then the VIX is just recocking the gun and readying to shoot tomorrow. We will see what happens. But the VIX is not ready to go below 20 yet. I believe that the VIX is going to give it another shot here, breaking above 25 once again, this time around with more vengeance. What about Bitcoin? Bitcoin broke the wedge consolidation pattern to the downside, consolidating in a saucer bottom formation before the Elon Mania started, and you saw Bitcoin prices surging higher. We have two support levels here, one minor and one major, extending from the lower end of the wedge. As of right now, we are still battling for the support of the minor trend line. The minor trend line is likely not to hold, so we are watching the main trend line. Breaking that trend line will open the floodgates for a bigger sell-off in Bitcoin. We have a crossing already in the MACD indicator, creating red impressions in the histogram. What about Churchill Capital? Similar story, the mania goes on all the way to the top, and then surprise, surprise, the merger is here. But who cares? The fair value is $15, and Churchill Capital continues to go lower, and we have a lot of call options gamblers getting burned. The MACD indicator curling lower, successful crossing, creating a red impression in the histogram, indicating a strengthening momentum to the downside. More pain to come for this name. And what about Apple from a 15 minutes perspective? Yesterday we talked about the importance of the level of 125 and 120. You gotta defend 125. And this is the chart to watch for the market. Apple is the leading indicator. We had a trend going on. We struggled over and over again to break above 125, but the trend line of support was there to keep us bouncing higher and higher. Eventually, Apple managed to close above 125. So the defense is successful for today, but the weakness is apparent. Apple is between very important three levels, 125, 131, and 120. Now that you have passed 125 successfully, you cannot trade lower. You cannot gap lower. That would be a disaster. You gotta continue pushing higher, and the next destination would be 131. If we see a down day tomorrow in Apple, understand that Apple has lower prices to go, and it will break the support of 120 to the downside. Here's Apple from a daily perspective. Massive sell-off, playing the bear flag, and right now the level of 125 is the sticky point, and the stock could consolidate here for a little while, going once, going twice, inviting riders to create another leg higher. If riders are not there or they're not excited by the price, Apple will go lower. At 120 it's not low enough. We'll go down 117, perhaps 113, and then we will see a point where the riders will be interested in hopping in the Apple ride. What about Tesla? What do we see here? 15 minutes perspective. I talked to you yesterday about the possibility of Tesla rising higher all the way to retest the resistance level at the trend line. Today we did exactly that, closing the gap from the day before and then marching higher and higher. We could go all the way to the trend line, but the weakness is here to stay. To explain that, zooming out to the daily chart of Tesla, we have oversold conditions in the RSI, which helping Tesla to bounce higher. But once we reach the trend line and that acts as resistance, I expect the weakness to continue, absent of an event or another pump from Elon and the likes. And remember, if we see the short squeeze mania continuing tomorrow, you will see cash taken out of the gains of Bitcoin to play the new surge of GameStop and the likes, which means that Tesla will trade lower in empathy with Bitcoin prices. And now, let's conclude this video with one of my favorite Warren Buffett's analogies regarding the mania in the market.
We're not good at the game of, when it gets into the speculative area, figuring out how far a speculative boom will go. If the fundamentals are attractive, we think we're getting a lot for our money, buying equities or whatever it may be. We'll make some money. We may not make as much money, remotely as much money as somebody who is plays out the last 30 days or 30 weeks of a real wild orgy. I mean, these things, they tend to be the wildest toward the end. But that gets back to the question, of Cinderella of the ball. I mean, you're there, you're having a wonderful time, the punch bowl is flowing, and the dance partners are getting prettier all the time, and you know at midnight it's going to turn to pumpkins and mice. And you look around the room and you think just one more dance, one more good-looking guy, one more glass of champagne, and you think you're going to get out of there at midnight. And of course everybody else thinks they're going to get out of there at midnight too. And in the end it does turn to pumpkins and mice. And in this game, as I've said, Adam Smith said it many years ago, a fellow named Jerry Goodman wrote under the pseudonym of Adam Smith, says the problem with that particular dance for Cinderella is that there are no clocks on the wall, and in the markets, if you're talking copper now, if you're talking internet stocks in 1999, if you're talking uranium stocks in the 1950s, there are no clocks on the wall, and the party does get to be more fun, minute after minute, hour after hour, and then it does turn to pumpkins and mice.